London, real estate capital of the world. Everyone wants to live, work, play and invest in the capital. But where might investors look to next? Could it be Birmingham, Manchester, Edinburgh or Bristol? Elsewhere in the UK perhaps? Or for some international or even domestic investors, is London the only game in town? To get to the heart of this issue, we've lined up a panel of investors to offer their views. Kent Gardner is Chief Executive of Evans Randall. Rob Howe is Head of UK Real Estate at Valad Europe. Peter McPherson is Commercial Director of Scottish Widows Investment Partnership, and Hideto Yamada is Managing Director for Europe for Mitsui Fudosan. And we'll be hearing from advocates for some of those UK cities. Each of them works for the sponsor of this debate, BNP Paribas Real Estate, and each believes firmly in the benefits their location has to offer. Let's start at the top. Can London keep its place at the summit? Here's Richard Garside making the case for London.
London is a global capital. Some say it might even be the global financial capital of the world. It has an amazing ability to evolve, as everybody's seen by how it has bounced back over the last 3 to 4 years from one of the worst recessions we've seen. That has given it global appeal, international appeal for investing in real estate. The London real estate market is some of the most liquid and best quality stock that we see in the world, and that is what is attracting the international investment. I've been in the city now for 17 years, and I can't remember a time when I've seen all the factors pointing in the right direction as we do today for investing in London. If you take the occupational market, over the last 3 to 4 years we've had a very restricted development pipeline coming through, which is meaning we have very little space coming to the market over the next 2 to 3 years. This added on to lease events that are pushing a lot of tenants into the market over the next 2 to 3 years is giving us some good tension in the leasing market. And certainly within the last year we've seen some very large transactions from all sides of the market, particularly driven by the TMT sector, where the likes of Google, Amazon, Facebook are all aggressively expanding into space, mainly to try and capture themselves building within this market. It's not just the TMT sector which are active, the insurance market again has been very active as well. And these are pre-commitments mainly taking place, the 2 big tower buildings coming through, NEC3, and now both nearly 60% pre-let at all rents above the market. And these premium rents being paid for pre-leasing is a reflection of the fact that we have rental growth on its way, and many commentators believe that is the case. If you look to the investment market, London provides very good quality buildings, let on long leases, and are very liquid buildings. There is an international appeal to this, whether it's a safe haven for your money or whether you are looking to diversify out of your local economy and local markets. About 75% of the investment within the city is from international markets. And this could be a factor of people already being overexposed to their local markets, wanting that global diversification. And London is always the first port of call. The combination of lack of supply has begun to push yields down. We've also already seen yield compression, but we are still 50 basis points ahead of where we were probably in the top of the market in 2007. Another factor which is benefiting London is the fact that a lot of big corporates who sit on big cash piles are heavily investing in London. They are buying their own buildings mainly to secure themselves positions, be it a retailer on Bond Street or be it JP Morgan or Bloomberg. They want to invest in London and they want to maintain their position in office space in London. So we're in a period now where we have very strong rental growth projections coming through, combined with limited supply of stock and maybe a decreasing amount of stock due to the amount of stock that's owned by overseas investors or corporates buying to hold. There could be further yield compression. And when you look at London as well, we haven't accounted in the fact that there is a big sterling benefit. Sterling is still devalued in comparison to other markets. So in comparison, our yields here of, say, 4.5% for the city still look good value in compared to the other global capitals, such as Hong Kong, Singapore, and elsewhere. So in terms of the main factors driving the London market, we've got very strong tenant demand, a very diverse tenant demand, more diverse than we've seen before, combined with a restricted supply of investment stock, and further yield compression is going to drive some very good returns over London for the next 5 years over London. This combined with the fact you have very liquid assets, so if for any reason you do need to exit, there is always a very strong depth of demand from potential buyers.
Richard joins us now. Richard, London has surged, of course, in recent years, but how much of that has been as a result of distress elsewhere? And could London lose its supremacy as quickly as it's acquired it?
Well, I think London's very much benefited from distress in the rest of the world because, as I say, it's been a home, it's an economic stability, has provided a home for that international money. And the real estate business as well is held up very well. Everyone acknowledges that it's very liquid stock, not only on the commercial side, but on the retail side and on the residential side particularly. And I think London is a centre for bringing in capital from elsewhere in the world. We've had emerging economies wanting to come in and invest in the stability that London provides. On top of that, you've got the global side of it where you sit centrally within the world map in between Asia and the Americas. Will it continue? I think very much so. I think we've only just seen the start of investment into London. We see new economies all the time which are being deregulated, where money is seeking to move outside of their local economies, and the first port of call is always London for the quality of the buildings, the standard of the investments, the standard of advice, the quality of the employees. So I think it will very much continue. And it is a finite resource at the end of the day. There's only so much more buildings we can build. And you look at the success of all the regeneration projects like King's Cross, it's pretty much 100% let up now, or very good interest in all the buildings that are coming through. So we can't build these buildings fast enough without filling them. And clearly, when you fill a building, there is a good depth to demand on the investment side.
Okay, thank you. Kent, an investor in London, of course. I just wondered what you made of what Richard had to say and whether there was anything that you wanted to tease out of him.
Yeah, I agree with what you've been saying, Richard, and I just wanted to make one comment about liquidity and supply. And as we've seen, yields have come in tightly, and we at Evans Randall have used that opportunity to sell about 750 million of stock in this last cycle, and a lot of it at record yields. But I thought one of the things is those buyers are sovereign wealth funds, and many of those buyers I don't think will be trading this stock again in the foreseeable future. So not only are we seeing a lack of supply, but we're also seeing that supply being taken off the market for the longer term. What impact do you think that will have for London as we go forward?
I think that will have a big impact going forward in terms of further yield compression. It's not just those sovereign wealth funds. You take for the city, for example, about 60% of the city is owned by overseas investors who tend not to trade as often as perhaps UK institutions or property companies. You overlay on top of that as well the corporates, which are buying their headquarters to be able to maintain a position. That again is coming out of that cycle. Again, you're getting change of uses to hotels, student housing, particularly residential in Westminster. This is all stock which is coming out of the market. So I think it will have an impact on yields going forward and will be one of the generators of further yield compression, particularly if we see the depth of demand continuing.
Okay, thank you. Hideto, a global investor as well. Is your belief in London as unshakable as Richard's?
Unshakable? I believe so. Particularly, of course, he has already talked about, the liquidities and the capital market, or risk-adverse behavior of the rest of the world to come to London. But on the top of that, what I want to stress and emphasize is, the players as an occupier are still keep on coming to London to open the business, to access to the global market, which is very, very key issue for us. Particularly, as you know, we are not just snapping up existing properties with 4% or 5% yield, but we want to create the value, we want to add the value, and at the end of that process, we want to see the higher return on that for long term. So we are buying the future, rent rather than existing rent. So in that sense, unless otherwise, we are very comfortable and confident who could be a player to come to the premises to generate the cash flow for us, which is a very, very key issue. As he explained briefly, of course, it used to be a financial players, investment bank, commercial bank, but now even financial sector had been very much diversified for the rest of the region. New players, Asia, Africa, natural resource rich regions will come to London to access to the global market. Even talking about the type of the financial industry, rather than just a conventional financing, but now we are talking of the fintech, which is, just a new type of industry in between technology and the financial, must be located nearby the city core. of course, media, creative, those, telecommunications, or even the biotech is also quite attractive to diversify, the source of the cash flow generation, which is quite key. And this is the reason why we still love to invest into London for quite a long time.
Okay, thank you. So, Richard, the occupational demand from the diverse range of sectors that Hideto mentions there, that's surging in the same way that investment demand is.
Very much so. I think it's a very important point. I mean, one of the reasons why historically people have always wanted to invest in the West End is because of the diverse occupier base. And now we're seeing a lot of tenants being dislocated from the West End because of the change of use to residential, depending on who you listen to in the stats, between 4 and 6 million square foot of space, of office space, has been taken out of the West End market for residential use. So that means these occupiers have to move elsewhere. And the first port of call is generally to move east, where it's cheaper to occupy space there. Your rates are cheaper, your service charge tends to be cheaper. So it's the first port of call, and that's why we are seeing far greater diversity. But it's also quite interesting to see as well, just in the last 2 weeks, we've had 2 big financial institutions sort of move ahead and look to pre-let 300,000 square foot buildings in both M&G and Schroders. So there is the diversity, and the sleeping giant of the financial markets has not been active, and suddenly it is becoming active. And these are pre-commitments for 2017. So people are looking in advance. So again, it's as diversified as I can remember the market in my time in the city.
Okay, thank you, Richard. Right, that's London. Let's head north to Edinburgh. Gavin Willins makes the case.
Edinburgh is a major European capital city. Relative to its size, it has a very strong and powerful voice, both on a UK basis, European basis, and world basis. It's renowned for its heritage, its history, its culture, but it's also a very vibrant and dynamic city. The City Council is often at the forefront of innovation and development, both by direct investment themselves and facilitating private investment. The ongoing investment in infrastructure is an example of the forward-thinking nature of the city. Right now, we have 750 million being invested in a tram network. That will be completed next year, albeit it has taken a little bit longer to complete, but we're already seeing the huge improvements from hard landscaping in the city. If you visited the city, the last time you visited the city was 15 years ago, you would arrive at the airport and you wouldn't recognise it. There's been over 240 million invested in the airport since 2000, and another 260 million to be invested by 2020. On the rail network, there's £1 billion being invested just now. Waverley Station and Haymarket Station are being extended and refurbished. To the south, the railway line is being connected to the borders. To the north of the city, there's £1 billion being invested in a new road bridge. So that just is an example of the forward-thinking side of the city, and we're really improving the connectivity going forward. Edinburgh has a particularly strong economy. Outside London, it's the strongest economy in the UK. There are more FTSE 100 companies based in Edinburgh than any other city outside London in the UK. It's the 4th largest financial centre in Europe, second in the UK. Renowned as home of Royal Bank of Scotland and the Bank of Scotland, now Lloyds Banking Group. Also, in recent years, we've seen significant newcomers in the banking industry coming to the market. Virgin Money have their headquarters in Edinburgh. Green Investment Bank have recently come, and Tesco Finance. Other hugely successful financial organisations in the city: Standard Life, Scottish Widows, Aegon, BlackRock, to name but a few. Out with financial services, key drivers of the local economy are science, technology, research. Edinburgh is home to the Scottish legal system, local and national governments as well. Tourism is a huge driver of the Edinburgh economy, as well as the world's largest annual arts festival. There's over 4 million visitors visit the city every year. It's an all year round economy driver as well. We have a very well-educated workforce. I think 44% of all employees hold a degree level, and as an educational side of things, there's 4 universities in Edinburgh. One of the oldest in the world is in Edinburgh, so a very, very well-educated workforce. From an office market perspective, there's an inherent tight supply of office space in Edinburgh. This has meant that over the downtime period, the occupational market has fared relatively robustly over the last 5 years. From an investment perspective, there's liquidity. There's always a strong demand for investments in Edinburgh, and there's a long history of a varied investor demand for the city, be it traditional institutions, overseas investors. Out with London, I think Edinburgh was one of the first markets the German market invested in. When the Irish came over to the UK, again, out with London, they invested heavily in Edinburgh. So to wrap up, Edinburgh has a very strong voice on both the UK, European and also world stage. It's a city people want to live in. It's a city people want to study in. It's a city people want to come and work in and bring their businesses to. It's a city people want to come and visit, and all of that is effectively brings the ingredients as a city that people will want to, and for a long time, want to come and invest in.
Gavin's with us now. Gavin, I guess the elephant in this very well-appointed room is the independence vote, September 2014. I just wonder how much of an issue, a deterrence potentially it is for investors and occupiers.
Yes, well, it is a big question that won't surprise you, is brought up frequently in most meetings just now, but we aren't seeing any evidence. It's an unanswerable question just now. We aren't seeing any evidence of investors stopping investing. I think a few investors did bring it up in 2012, almost when as an excuse not to invest. There wasn't the pressure to spend money, and they made the point, oh, I'm not sure about independence. 2013 has shown that's very much not the case. By the end of this year, we will have traded in the office market over 400 million this year, which compares to last year of round about 30, 35 million, primarily because of the lack of stock last year. But that is a wide range of investors. That's overseas, UK institutions, and many of them, in fact almost all of them, going to closing dates with considerably a number of disappointed underbidders. So we're certainly not seeing that is stopping investors making any investment decisions. And you could take that as the whole context for Scotland, but even in Edinburgh, the big if Scotland did become independent, which personally I think will not happen, but it could only be good for Edinburgh, because Edinburgh is going to be at the centre of it. But as I say, that is something that doesn't seem to be coming up in the decision-making process just now. From an occupier point of view, we've just seen BlackRock take the largest space in the market last year of 80,000 square feet. We've had companies like Avaloq coming into the city, Amazon expanding. So again, we're from an occupier point of view, I think we're going to be over 700,000 take up this year, which is increasing year on year. So we're not seeing that in the market just now.
Okay, thank you. Peter, Scottish Widows, soon to be Aberdeen Asset Management, a strong footprint north of the border. Is there more that you'd like to hear from Gavin?
Well, Gavin, not particularly much more from you. I tend to agree with most of what you said. And I guess my observation is I'm lucky because I work in London and Edinburgh, so I can compare the two. And I'm very happy always to be in Edinburgh. I think, from a business perspective, it makes lots of sense. The stock is good. Culturally, it's, up there. Retail is good. So I always enjoy my time in there. So I guess I am a fan of Edinburgh. Yeah. Not to say I'm not a fan of London too. But of course, Scotland isn't just about Edinburgh. There's also Glasgow. Sure. Dare I say, there's also Aberdeen. And I think those places also have a value, and we invest in those as well as Edinburgh. Yes,
that's very true. We tend to have just talked about Edinburgh today, but the Aberdeen market just goes from strength to strength, and I think that is getting the attention of more investors now than it used to do. Traditionally, there were only a few UK institutions that invested in Aberdeen, and that's very much not the case now. Same with Glasgow. I am an advocate of Edinburgh, but I'm equally an advocate of Glasgow as well.
Thank you, Gavin. Rob, as an investor, Valad, is that independence question, that uncertainty, an issue for you?
It's not been an issue for our investors at this point in time. Clearly, as we get closer to the vote, then it might make investors a little bit more nervous, but I think it's been seen by the occupational stories that Gavin's talked about, some of the investments that have been made in Edinburgh. We recently bid on an investment ourselves on the outskirts of Edinburgh, that investors are still entirely comfortable in this. Maybe people aren't quite seeing that independence will happen at this point in time, and therefore they're still quite comfortable to invest north of the border. And we're certainly of that view, and we wouldn't tell our investors to shy away from Scotland at this point in time.
Okay, and Gavin, is it different for occupiers? If you're looking at potentially a move to Edinburgh or Newcastle at the moment, you might be, all other things being equal, you might be persuaded to go to Newcastle.
Well, clearly I'd say no to that. Again, there's no evidence of that. The occupiers have been coming, as evident by the take-up figures, and also existing occupiers have been expanding. We are seeing companies like PwC, Brew and Dolphin, all moving to new space and expanding the amount of space they occupy. So no, I don't see it as being different for occupiers. It's not something that's been brought up, certainly. Thank you, Gavin. Right, from Edinburgh to Birmingham, and Andrew Meikle is Birmingham's advocate.
Birmingham and the West Midlands. So Birmingham is the second biggest city in the country with a population of 1 million people, a catchment of 3 million people. It has a very diverse economy. We produce something like 150,000 graduates per annum for our 5 universities. And being in the centre of the country has meant that our employment base is incredibly diverse. Not only do we have financial service sector, which employs 30,000 people in Birmingham, but we also have legal and professional sector. In fact, it's the second biggest legal and professional sector in the UK after London. But on top of that, we also have an incredibly diverse range of manufacturing and engineering. It's the home to Jaguar Land Rover. It's the home to Rolls-Royce. It has a huge aerospace and manufacturing sector. In fact, it's the biggest in the UK. Advanced engineering represents something like 25% of our economy. And the West Midlands economy produces, or is valued at, some in the region of £90 billion. So being in the centre of the country, the government has made a decision to put a huge amount of infrastructure into place. And the city's transformed over the last 20 years. I worked in London for several years. I made a decision to move to Birmingham as a consequence of the infrastructure improvements and the quality of life that the city brings. Infrastructure improvements include Birmingham New Street, £600 million redevelopment that's halfway through. Phase 1's finished. Completely redeveloped the entire station, and will also provide 200,000 square feet of retail and leisure, of which half is pre-let to John Lewis, a new entrant into the Birmingham market. Then you also have the Metro line, a tram system, which is under construction now, £130 million, that runs from the second station in Birmingham to New Street and through to the CBD. On top of that, Paradise Circus, a new £30 million development. Well, I say 30, it's been subsidised by the government to 30 to date, but potentially up to £60 million of infrastructure works will go into place for a new mixed-use scheme that will provide about 1.8 million square feet. So overall, infrastructure works are quite high, and I haven't mentioned High Speed 2. High Speed 2, currently estimated to cost £40 billion, will provide a link from London through to Birmingham by 2025 that will take 40 minutes. It's only an hour and 20 minutes at present. So the impact on the city will be gigantic. It will bring more employment in, and it will also do something that's already happened. It'll mean more employees coming out of London and taking space for back office functions and administrative functions, such as Deutsche Bank. Deutsche Bank had no presence in the city 5 years ago. They've gone from 0 to 250, 300,000 square feet in 5 years, of which they've taken 100,000 square feet in the last 12 months alone. And those are predominantly jobs that have been relocated from the southeast. Being situated in the middle of the country within 4 hours drive of 90% of the population. Consequently, infrastructure works are also being undertaken at Birmingham Airport. The runway is being extended, which will be completed by early 2014. That means that Birmingham will have access to destinations further afield, including the Far East, the Middle East, and the west coast of North America, as well as Central and South America. The city market itself has struggled for some 3 or 4 years occupationally, given the oversupply. But that supply is now coming to an end. We have no more than 18 to 24 months worth of grade A supply remaining, and consequently we are now starting to see headline rental growth as well as net rental growth. There is very little development ongoing and very few sites capable of being delivered. Consequently, rental growth is only going to move one way. So ultimately, the city is moving forward. The government has made a decision to put money into the city. We know that the fundamentals of demand and supply have improved tremendously. We're expecting to see take-up this year exceed long-term averages.
Andrew's joined us. Andrew, you said the city market had struggled in recent years. Some say that Birmingham's also lost ground to Manchester in recent times. I just wonder, is there concrete, firm evidence that the city's bouncing back?
Well, I think there is. I mean, Birmingham and Manchester have a lot of similarities in terms of size and scale. I think the difference between the cities is predominantly geography as much as anything else. Birmingham's proximity to London is obviously very important. And I would suggest that certainly Manchester as a brand is probably better known in certain parts of the world, whereas Birmingham is probably more, as an asset, more transferable to European investors who understand it and can draw comparables with their own cities. I think where Birmingham had struggled for a couple of years was occupationally in terms of supply. The city was behind Manchester. There was more supply, even though take-up actually is relatively comparable. I think we've got to a point now that the cities actually have very similar profiles in terms of supply moving forward. So generally rental growth assumptions, etc., are roughly applicable for both cities. But it's interesting to note that both cities have very similar investors and who are very comfortable with both cities as asset classes.
Okay, thank you. Kent, Evans Randall isn't currently invested in Birmingham. I just wonder if there's anything that Andrew might say that might persuade you it is an attractive option.
Yeah, I think some of Andrew's comments have been quite relevant this afternoon, particularly in relation to the supply pipeline and how there hasn't been A-grade stock created for some time. And I think, Andrew, you said that maybe there was only 2 years of remaining A-grade stock to be taken up. I'm interested in who's going to actually develop that new stock and more importantly, possibly in this market, who's going to fund that as well?
Yeah, I think we're still a way away before we start to see speculative development moving forward. I think that until we start to see demonstrable rental growth, that market won't return. I suspect that'll be another 18 to 24 months before it does.
There's talk around Snow Hill, though, isn't there?
There's discussion on Snow Hill and also around Paradise Circus, both of whom have serious interests on pre-let activity from at least one, if not two, different occupiers. That will probably kickstart the next wave of development. The schemes that are more deliverable are Snow Hill, the third phase of Snow Hill, and also Paradise Circus, which is obviously having a lot of money pumped into it by the public sector in terms of the infrastructure required before buildings are built. But the general consensus of the market is the next one or two pre-lets will then drive the next phase of development, which will then probably drive speculative development. We know of a number of investors who would forward commit developments where there was some exposure to speculative development, but underpinned by a pre-let.
Thank you. And Rob, Valad's view on Birmingham and the Midlands?
We're very positive. I'm actually locking horns with Andrew at the moment on one deal at the moment where we're buying some warehousing. So we're very positive about the Midlands. We agree with the comments about Jaguar Land Rover, the car industry, how that's booming within the country, and that's helping the economy around the Midlands.
Thank you, Andrew. Okay, we've heard from the cities. Let's hear more from our investors now. And if I can ask each of you, before we get into that big question, whether your views have been changed by what you've heard today, I'm just interested in your views about the market and whether we're in the middle of or at the beginning of a full-blown recovery. Hideto, can I start with you?
Well, obviously, from this September onwards, the people's momentum, particularly focusing the future growth of the general economy, became to be more bullish, which was proved by a number of the statistics. So cap rate stays all the time as low as historical level, but the people start underwriting the future rent as more stronger or more optimistic. So when I try to analyze the new opportunities coming in the market, it might be a bit more tougher comparing to half a year or 1 year ago. Obviously, 2012 is a year particularly weaker for occupation market. So although the cap rate stays all the time quite low, but when we looked at the absolute pricing of the future opportunities, it still stay or almost hovering into the historical average level for last 20 years. But now probably we are coming to a bit higher zone in terms of the absolute pricing, particularly affected by the people's momentum underwrite more stronger for the future rent.
So you still sound fairly cautious there.
Well, we try to all the way the cautious, but again, because of the more and more occupier, more diverse occupier are coming into greater London market. So in the mid-term and the long term, I'm quite bullish. But for the short-term cycle, I have to be more cautious than a year ago.
Okay, thank you. And Peter, it seemed to me that there was a bit of a turning point round about the spring, round about March, most people point to, and things have improved since. So we're several months on for that. Can we now be confident that the recovery is assured?
Yes, I think we can be confident. I think definitely I agree that the market has turned and it seems to be gathering pace. We'll probably have a debate at some point about the secondary market and where yields are going there. I think what's also interesting is that we've been talking about clearly investing in central London, but also the regions. And I think it seems to me that we're investing outside London. Everywhere else, not everyone else, but many other people are doing the same thing. And I think that we've also spoken about how the sort of international capital flows have affected the market. I think what's really interesting over the last 6 months is that I've noticed that domestic pension funds are coming back in, the consultants are upweighting their allocations to real estate. So I think that too is clearly impacting on the overall health of the market.
Okay, and is lending freer? Is that helping too?
Yeah, I guess lending is freeing up a bit. We at SWIP don't actually use much debt, but my understanding is that it is becoming more available, and that must be having a positive impact.
So, Rob, full-blown recovery?
Yes, we're very positive about it. I think the question mark is whether the occupational market is running ahead of the investment markets at this point in time. You can clearly see from the springtime where more money has come back in and is being allocated to real estate, and we see it every time we're bidding on a property, where it used to be that it was one or two parties bidding, but now we're getting into second and third rounds of bidding. But whether that occupational demand is there with the investment demand, that's still to be seen. But I think that's behind the curve. Well, I think as investors, we're meant to be predicting where the occupational markets will be, and we're looking at markets where there's been no development for 4 or 5 years, and therefore a shortage supply, and therefore there hasn't been rental growth yet, but it will come through over the next few years. But we always.
Which markets are those geographically?
Well, if we talked about some of the provincial markets in terms of the Manchester, the Birminghams, where you can see a lack of Grade A space, there's talk about London, but obviously yields have compressed a lot in London over the last few years. But and you can clearly see it with the distribution warehouse market. That's probably one of the earliest one with the internet companies taking up so much space. There really is starting to be rental growth within the distribution warehouse sector. In the northwest, there's no spec development over 100,000 square feet that's available, and there was a massive oversupply a couple of years ago.
Okay, thank you. And Kent, we've seen London surge. We've seen some regions begin their recovery, but is that recovery national, or is it very much urban and core city related?
I think it's a bit of both, but I think we are starting to see some growth in some of the provincial cities, which I think is good. And we're also starting to see investors who maybe are focusing on London in the past, as we've had foreign investors come into the market, have been considering more the provincial areas and the regional towns in the greater UK area. I think that's a good thing. One of the things is we see in central London, 80% plus of the investors are foreign investors, and a high proportion of those are first-time investors. But outside central London, what are we seeing? We're seeing 80 to 90% of those investors are actually UK institutions and UK investors.
And where could that go in the next 2 years?
I think that will continue, and I think what we'll see is.
You don't think we'll see a greater proportion of overseas investors beyond London?
If that's going to occur, I think what needs to happen is that UK-based investors, UK-based developers need to work with foreign investors to bring them beyond central London. They need to bring them to the regions and explain to them what's going on there and show them the opportunities. I think there are some core cities where foreign investors come, and we've heard about some of that today from Andrew and from Gavin, but I think there needs to be, to see that really grow, there needs to be the UK investors bringing those parties and showing them the opportunities.
Do you think UK investors are doing enough to bring in joint venture partners?
It's interesting, and I think with the supply of capital and the diversification that it's looking for, there are a lot of parties doing that now. They're doing that in central London, and they're developing relationships which we have seen some of those spill outside central London. And I think from our perspective, we hope that that continues as well.
Okay, and I just wonder, sitting in your investors' investing tower, as it were, when you're looking at London as an opportunity, central London, the donut, the southeast, the UK, Europe, the world, where you see those fortunes heading, are parts of the world heading in one direction and parts heading in another direction? Same for the UK.
Yeah, I think our focus has generally been on the UK and Europe, and that's where we would say our specialist area is. What we do really like about the UK is the transparency in the market and the liquidity. That's not only in central London, I think, but that extends to the regions as well. And that's a core focus for us in making investment decisions, that we have transparency in terms of the markets we're investing in, and that there's liquidity as well, not only on entry, but also on exit from those markets.
And do you judge them against each other? How competitive is it?
Yeah, we're not so strategic in terms of lining up cities themselves and markets against each other. At Evans Randall, what we are is opportunistic in our approach, looking for value for ourselves and our co-investors. And that can be found in any market at any time. Obviously, it's easier to find at points in the cycle, and that's what we're looking for.
Okay, thank you. Is it the same for Valad, Rob?
Yeah, Valad is a very much a bottom-up investor, but what we do regularly is what's known as our house view, and all our country heads will put together their views on the individual markets and where they see the opportunities in those individual markets, be it the UK, Germany, Nordics, and then we're looking to marry up and find investors that have got similar mindsets, and sometimes trying to convince those investors that actually you should be looking at industrial in Germany at the present time as opposed to the UK. So we're looking as an organisation very much pan-European, but once you've got that top-down approach, what we then try and look at is from a bottom-up approach, because very much it is about the occupational market, and you've got to find tenants for buildings.
And when you put the UK house view forward to a European level, is the UK looked upon as a leader, a laggard?
No, it's been a leader. We've all seen the GDP figures, and therefore we have money. We're investing in the UK at the moment. We're investing in Germany. But it's harder to convince investors to go somewhere like France at this moment in time. But that will happen over a period of time as Europe improves.
Okay, thank you. And Peter, SWIP's approach in terms of the house view, as it were, on the UK and the UK relative to other places as well?
Well, in terms of a house view, we're looking very, the UK house view is very positive, and quarter on quarter over the last probably 4 quarters, the forecasts have been going up over the 5-year projections. But we're not exclusively bound to the UK. We also take a view on continental Europe. And I think there too that we can see some positive signs. Clearly, it's a Europe of 2 halves, Northern Europe, Southern Europe. But I think in Northern Europe, if you look at, and the Nordics in particular, in Germany, those markets actually have done pretty well over the last 5 years. I'm not sure there really was a downturn in Stockholm or in Oslo or Helsinki. I mean, there may have been, but the point is those markets have remained pretty healthy, and certainly they're markets which are of interest to us.
And London, in a recovery, markets can start to look pretty expensive pretty quickly, and London, it has been said, is starting to look pretty expensive. Is the UK starting to look expensive?
Well, it's all relative, isn't it? So I guess London is looking expensive relative to 5 years ago. And I guess it's fair to say that whilst we have been still investing in London, our focus is perhaps moving more into the provinces now, into the regions. So, I can support what people have been saying about Birmingham and Edinburgh, because that does sort of resonate with us. We're not going to stop investing in London. Actually, I think one of the interesting things about London is, I looked at some research recently, and it was talking about capital movements in real estate. And it was saying that the US, I think in the last 12 months, has attracted more overseas capital than anywhere else. And I guess that makes sense because it's the biggest market. But in terms of sort of cities, London has seen twice the amount of money coming in, overseas money, than New York. And I think that in itself tells a story.
So Hideto, when Mitsui Fudosan is looking around the world, is the UK starting to look a bit pricey?
Well, yes, it became to be more pricey comparing to half a year ago or more. But as I explained, our objective to look at the market rest of the Japan is having understanding the nature of the difference of each market. London's attractiveness is all the time liquidity, transparency, more diversified industry as an occupier. In fact, for me, when I look at London brings us all the time opportunity to invest fairly, transparently to the foreign investors. As he pointed out, having the experience to live and work in New York is big market, very bullish market, very innovative market. But whether it is really open to the foreign players, I don't think that it's not necessary to be really open. Or in other words, there are much more stronger, again, more innovative players backed by a lot of fund or financial institution taking such a risk. So it's a relatively to London, even challenging market. So considering the size of the market, liquidity opportunities all the time there, London is fairly well positioned from our viewpoint when I look at more like sophisticated Western, the world economy and the market.
And when you look at some of the statements that are made politically from Europe, from London, that there may be a mansion tax, there may be house builders being forced to reduce any land banks they may or may not hold. Does that worry you? Can that sort of regulatory change and political change affect your decision about where you may invest?
Well, taxation is obviously the issue. I will remember that after the new government raised the income tax from 40 to 50%. There are huge debate whether London still hold the position to attract most talented, financial dealers comparing to the other competitors like Geneva or Paris. So that is quite important, aspects for us to keep on monitoring that. Regulation-wise, I'm comfortable in terms of the relatively consistent, policy here. Of course, there are some debate from time to time, like the planning consent to be issued to some iconic type of properties, whether who are the ultimate decision maker for us, and from our viewpoint, taking such a development or real estate risk, whether we can be continuously comfortable with those authorities or not in a more like micro level. But overall, on a state level, we are quite comfortable. Because probably, as a global investor or real estate players, we are looking at Asian market, mainland China, and UK, continental Europe, and US. So, of course, comparing to China and the Southeast Asia, policy, are more consistent, obviously. Their legal system is there. A tenure is very well protected, and number of professional advisors to make us easier or quicker to make a decision. So in that sense, looking at that, we are still comfortable to keep on investing.
Okay, thank you. I said I'd come back to you to see whether you've been persuaded by what you'd heard today in terms of some of those opportunities that do exist within London and outside London. And I've realised that it would take more than an afternoon to persuade you to invest elsewhere. But I just wonder whether seeds have been sown. Kent, if I can start with you. Are there certain regions that are looking more attractive?
Yeah, I think seeds have been sown. I think Andrew and Gavin have put forward strong cases for Edinburgh and Birmingham this afternoon. And I can see opportunities there. I can see opportunities there not only in being first movers, which we've already seen, and as other investors come into the market, but also in terms of growth. And as we start to get some lift in the economy and we start to see real UK businesses expanding, taking up extra office space particularly, and that will lead, I think, to recovery and ultimately to some rental growth in the regions, which makes it interesting for investing.
And do you think there's things those regions could do themselves or the government could do to make that case even more persuasive, whether it's infrastructure investment, whether it's the small amount of control local authorities have over their own tax base? But are there steps that those who work and thrive locally can take to persuade you?
Yeah, I think that's always important. What I think is interesting is where those cities do things themselves, not so much necessarily in terms of infrastructure, although we've heard a number of the cities have spent a significant amount on that in the past, but also I like the idea of the branding and the putting the city forward in terms of what it's good at, whether that's a media hub, whether that's a banking area, not only in the UK but internationally as well. What we've found with co-investors is if a city has a brand, has a presence, that can be in terms of what's been going on there, but it also can be in terms, unusually, as to say their football team or whether they're on the map from that perspective. Once that occurs, then foreign investors start showing some interest in those areas. They know about them, they've heard about them before. And I think that makes the discussion around investing a little easier, and it's a more interesting and easier place to start.
So, Rob, Kent talked there about the importance of clustering, about how influential success on the football field can be. I guess you could include flamboyant city mayors in that as well. Do you think there's more that can be done regionally, locally, to persuade investors to back a particular city, back a particular region?
If you look at the success of Manchester, obviously with the football team, and what's
football teams.
Teams. Being a Man United fan, that's quite difficult for me to accept. And what Sir Howard Bernstein has done, the city has been transformed over the last 10, 15 years. It's quite incredible. So the cities have become very good at promoting themselves. But if you look at it, are they just trading that off against another provincial city? Are they trying to steal from Leeds and Birmingham? When you look at and you talk about, as Andrew did, Deutsche coming out of London and locating in Birmingham is the fight between the provincial cities, and this is where they've got to be better at competing, because they'll never compete against London, and I think that's what they've really got to accept, that London is a global financial centre and much stronger. But I think if you look at it historically and where the cities are now, they are far better at promoting themselves and promoting their offers, so to speak.
And some better than others.
And some better than others. And being a Mancunian, I would say Manchester's done a fantastic job over the last few years.
Peter, I'm always being told by investors that they have a league table of helpful cities on the back of the office door. They never tell me which cities are more helpful than others, unfortunately, but perhaps Rob suggested some that top that list. I just wonder whether there's anything that you've heard today that has been persuasive, or whether there's more that you'd like to see certain cities, certain regions do to attract you and your peers.
Yes. Well, I think a lot of what's been said this afternoon has been persuasive, and I think in terms of cities that are on the buy list, I'm not sure that too much does change even over the decades. You think about the 6 or 7 sort of big regional cities, Birmingham, Leeds, Glasgow, Edinburgh, Bristol, probably missing a couple. Those have always been centres of commerce. I think we'll never say never, but I don't think they're about to go out of business. And at different times in the cycle, I think they all have their attractions, and I think there are going to be places where institutions are always going to want to invest. Okay.
And Hideto, you're pretty London-focused currently in a UK sense. Can you see yourself investing outside of London? And has the case been made for Scotland or Birmingham in particular?
Well, the area we started looking at is unfortunately not with the secondary cities in the UK, but more like for continental Europe gateway cities, and not necessary because we are not just a financial institution looking at some opportunistic, distressed type of opportunities, but more like long-term, investors and players. So what we have done in continental Europe is from west to the northern part of the Europe, predominantly Paris, gateway cities in Germany and Scandinavian, the regions, where economy is relatively stable, and also particularly for some cities have a very good prospect for the future growth of the economy. So we have explored a number of the cities to looking for who could be a long-term partners for us to access to the opportunity and also make sure the delivery of the product in the future in terms of the asset management play or refurbishment or development too. So I hope that we can find out some cities and opportunities within the near future extended from UK. We want to possibly copy the similar business model that we have done for the last few years here in London to the other cities too.
And could those gateway cities be Manchester, for instance, which is very well connected with China and a strong regional economy?
Well, I shouldn't yield out any opportunities, but from our perspective, we are diversifying investment into Europe, US, Asia. So it's difficult for us to look at some micro market in one, the locations, and particularly looking at the secondary cities. But obviously, Southeast region or Greater London could be we can seriously looking at.
Okay. And Peter, is there a particular region, a particular sector that's attractive to SWIP right now?
I wish I could say there was a particular one, but I think it's all attractive to us right now because the market's bouncing back. We have money to invest. And so, London remains on our radar, but we are focusing, I would say, in the regions, but no specific region.
And Rob, beyond Manchester?
Well, we're predominantly focused on buying good secondary property. It provides us with a very strong income yield, and we're looking for rental growth coming through.
And Kent?
We're opportunistic in our approach, so we're looking at all opportunities and just trying to find value. And I think that'll come predominantly from the regions as we've seen the change occur in London as well.
Thank you, Kent, and thank you to all our panellists, and thank you to our city advocates. I think we've heard today that there are some very strong cases to be made from some of the regions in the UK, and we've also heard that the economic recovery is now in full swing. Plenty of reasons to be optimistic about 2014 then, and thank you for watching.